Hello, and welcome to the Affordable Care Act Taxes and Fees webinar. This is a 1-hour CE, so we will be doing some education questions along the way. My name is Misty Baker, and I work for the Independent Insurance Agents of Texas. You can have my contact information, which is on the slides, both my office, cell, and of course texting, as so many people like to do these days for education. Also, you can email me at mbake@iiat.org. You'll notice in your dashboard for your GoToWebinar, you're going to see several items. The first item has a list of attendees. There's a questions box, as well as a handout section. If you'll just click on the handout section, all the slides from today's presentations have been made available for you. We're also recording the session today, so if you want to go back and review any part of the taxes and fees that we discussed today, you're more than welcome to do that. With that, we're going to get started. Please feel free to ask questions as they come up. Just a reminder today that upon completion of the course, you'll have an understanding of major taxes and fees imposed on employers, plan sponsors, and health insurance carriers by the Affordable Care Act. This course is going to explain who is subject to each tax or fee, how to calculate the tax or fee, how to pay it, and how long to keep that documentation as well. When we talk about the Affordable Care Act, we have several new taxes and fees being addressed. Today we're going to address the major ones, the 2013 through 2020 Patient Center Outcome Research Institute fee, or PCORI. We see another permanent tax with the additional Medicare payroll tax, the transitional reinsurance fee, the health insurance carrier tax, and then the high value plan tax, also known as the Cadillac tax. There are other taxes not addressed in this course, like the 3.8% net investment tax on higher income taxpayers for investments, the 2.3% medical device tax imposed on medical device manufacturers, the increased tax on non-qualified medical expenses from a health savings account, and the increase on the medical personal income tax deduction. Other indirect taxes like the annual limit on the health flexible spending accounts and the removal of over-the-counter drugs from FSAs, HSAs, and HRAs without prescriptions are also not addressed in today's presentation. We do, however, want to start with the Patient Center Outcome Research Institute fee. This fee was begun in 2013. We call it PCORI. It's the PCORI fee, or the CERF fee, which stands for the Comparative Effectiveness Research Fee. Additional information about the Institute is available on their website at pcori.org. It's regardless of what you call it, this fee is a part of the Affordable Care Act and is intended to help us all make us all more informed about health decisions by advancing the quality and relevance of evidence-based medicine through research. It is funded in part by fees by insurance carriers and plan sponsors of self-insured health plans. The fee collection began in 2013 and will be collected for 6 years. Each employer must file and pay the fee on their own, even if they are part of an aggregated group. However, if there are 2 or more related employers that are part of one self-insured plan, only one of the employers files and pays this fee. The employer who was designated as this plan sponsor, and really you want to look for your plan document to make this determination, is the one that will file that particular fee and pay it. What does PCORI actually do, and what are they studying outside of the marketplace? So what we see is we have over 400 research projects approved. 41 states also have funding to provide research. We see over $1 billion in funds was awarded to study certain kinds of projects, and certainly these are not all of the projects that will be studied in the future, but this is just a brief synopsis of them. So we see that we have 43 mental and behavioral health studies, 40 cancer studies, 26 cardiovascular health, 21 rare disease studies, and then finally 20 nutritional and metabolic disorders. Breaking it further down, what we see PCORI doing is studying projects by the population as well. So we see 237 different studies really aiming towards racial and ethnic minorities, low socioeconomic status, older adults, women, and children. The fees amount and the collection or payment date are based on when the plan year ends. The due date is always July 31st of the calendar year, which was just a few days ago. But remember that it's after the plan year ends. For example, if your plan that ended in 2016, you will pay the fee by July 31st of 2017. The chart on this slide illustrates the fee amount and the due date based on when the plan year ends. The federal government's fiscal year always begins in October, so the fee amount changes every October because that's the way it was written into the Affordable Care Act law. Fully insured plans use the date of the medical plan year when that ends, the day before the renewal, but self-insured plans need to look at their ERISA plan year to determine when the plan year ends. The ERISA plan year does not always coincide with the medical renewal date. The fee is paid on the average number of covered or enrolled lives. That also includes dependents. The PCORI fee applies really to many different kinds of plan. This slide illustrates some, but not all of the types of plans that the PCORI pay the PCORI fee. The IRS maintains a complete chart at the link at the bottom on the slide. Notice that health FSAs and HRAs that are not considered HIPAA accepted benefits are subject to the fee. These plans are considered self-insured, so employers who maintain these kind of plans must file and pay the fee on their own. Employers with a fully insured group health plan and non-HIPAA accepted health FSA or HRA will end up paying the fee twice. The fully insured carrier will pay the fee for that plan but passes on the fee in the form of higher premiums to the employer. The employer will then pay the fee for the non-HIPAA accepted health FSA or HRA. The IRS gives the non-HIPAA exempted plan a small reprieve by only making them pay the fee on the average number of covered or enrolled employees, not dependents. For example, there are 180 covered lives in a fully insured plan. The insurance carrier will pay this fee but pass on the cost to the employer in the form of premiums. The employer also maintains a non-HIPAA accepted HRA in which all 75 full-time employees and their 105 dependents are enrolled. The employer pays the fee on the 75 full-time employees, not the 105 dependents for the non-HIPAA accepted HRA. Employers who are the plan sponsor for both a self-insured or self-funded group health plan and non-HIPAA accepted health FSA or HRA that have the same plan year only have to pay the fee once. If the employee or dependent is covered by both a self-funded group plan and the non-HIPAA accepted health FSA or HRA, the covered individual is only counted once, not twice. So individuals not covered by the self-funded group health plan, but who participate in the non-HIPAA accepted health FSA or HRA are counted once per employee, but do not include dependents. Note, individuals who participate in a health FSA or HRA but not in the group health plan could cause other complicated issues as well. As noted earlier, the fee is paid on the average number of covered or enrolled lives, which includes dependents. Also, don't forget about your COBRA participants or anyone on state continuation. Employers with fully insured plans will have to pay the fee by the insurance carriers. As I mentioned before, carriers have 3 methods to calculate the fee. Employers with self-insured plans, including non-HIPAA accepted health FSAs and HRAs, have 4 methods to calculate the fee. And employers can choose the method that is best for them. The methods are actual count, snapshot count, snapshot factor count, and the Form 5500. We'll go over each one of these methods in detail today. So let's start with the actual count method. This method literally requires the employer to add up the number of covered lives for each day of the plan year and then divide the number of days in the plan year. For example, if an employer adds up the number of covered lives for every single day of the plan year, let's say that comes up to 700,435. This number is divided by 365, which is the number of days in the plan year. The answer is 1,919. This is the average number of covered lives under the actual count method. Caution, sometimes there are 366 days, which you have to make sure you're using the right divider for those particular years. The snapshot count method is similar to the actual count, but it only uses 4 days per plan year rather than every single day. So employers choose 1 day of each quarter and add the number of lives on that day or within 3 days of that date. You add those together and you divide by 4, which is the number of quarters in the plan year. So in my example here, the employer chooses to use the first day of each quarter for the method. On January 1st, they were 1,958 covered lives. April 1st, they had 1,953 covered lives. July 1st, they had 1,966 covered lives. And October 1st, they had 1,955 covered lives. The total for those 4 days is 7,792. Then you divide that by 4 because we're just looking at those 4 particular days. And this is the average number of covered lives under their actual count method. Employers can use any day of the quarter to make a snapshot count. And what I'm illustrating on this slide is really looking, using the first day of the month, but using each of the 3 months. So when we look at 1,948 is the quotient or the answer using the first month in yellow of each quarter. We look at 1,925.50 for the second month, which is in blue, and each quarter of equals 1,917.50 for the third month in the green. So there's no direct guidance from the IRS, but the examples and the regulations do drop the decimal point. So when we look at the snapshot factor, it's very similar to the snapshot count method, but only count the number of participants, generally employees, and not the dependents. You count the number of participants without dependents, add it to the number of participants with dependents. After multiplying that number with dependents by 2.35, you divide the total by the number of quarters per year, so we have 4 quarters per year. Obviously, you see that some of these methods get pretty heavy in the math. Let's look at this snapshot factor method. In this particular example, this employer chose to use the first day of the first month of each quarter to determine the snapshot factor method. In January, they have 600 participants with self-only or employee-only coverage and 614 dependents. So 614, this number with dependents is now multiplied by 2.35%, and added to the 600 employee only, which totals 2,042.90. This is done each quarter, and then we total that up and then we divide that by 4. So in this particular method, we're looking at 1,994 as our final answer, and this is the average number of covered lives under the snapshot factor method. The last allowable method for self-insured or self-funded plans is the Form 5500 method. You add the number of participants at the beginning of the plan year to the number of participants at the end of the plan year, as noted on the most recent Form 5500. That Form 5500 generally filed if there are more than 100 or more participants on the first day of the plan year. So in this example, we have 1,214 participants at the beginning of the year and 1,140 at the end of the plan year. You add those up. This is the average number of covered lives under the 5,500 method. If the plan does not allow dependents to be covered, you want to divide that answer by 2. There's some caution to note. If the employer is an ALE or an applicable large employer and dependents are not covered, remember that you could incur penalties at that point. So how do you determine what's the best method to count the PCORI or calculate these fees? The first thing to remember is the more difficult the math, the more opportunity that your client has to make a mistake. Not one method is better than another. Knowing all of the methods and certainly giving your client options is really a great thing to do as a broker. But you don't want them to be making math mistakes when they either calculate number of covered lives or calculate dependent lives. So employers should count their average number of covered lives using several methods really to determine which is the best and, quite frankly, the cheapest for them to use. What this chart shows you is that all the methods by the employer that we talked about with all the examples integrated on the prior slides, we didn't illustrate the snapshot factor method using the second or third months of each quarter, but employers can go ahead and do this particular calculation. Turns out the snapshot method count is using the third month of each quarter is the best and least expensive for this plan, since there were only 1,917 average covered lives. This example is from 2013 when the fee was $2 per covered life. It's higher now. One of the things I always like to remind us as brokers is that, again, math is hard for some of our clients, math is hard for some of us, and so you might want to get really good at one or two methods to count for PCORI and repeat that client after client so that you have a really good understanding of when to count them. If you're going to integrate and really integrate that 2.35 factor for dependents, you want to make sure you have those actual numbers in place. You do not want to guess when it comes to your PCORI fees. So the plan sponsor, and that's generally the employer, is responsible for calculating, reporting, filing, and paying the fee on a self-insured plan. The fee is reported and filed on Form 720. This is a quarterly excise tax form. If the employer doesn't owe any other excise taxes during the year, the form's only filled out once per year for the PCORI fee. Third-party administrators cannot pay the fee on behalf of the plan sponsor. And because the fee really is imposed on the employer or the plan sponsor itself, not the actual plan, the fee cannot be paid with plan assets, and those generally include employee and participant contributions via payroll deduction. It must be paid from the employer's or the plan sponsor's general assets. The fee is generally tax deductible as an ordinary and necessary business expense. Here is an example of, this is just a partial screenshot of the Form 720. What we're looking at really is Part 2 of the form, where the PCORI fees are noted. There also is a separate payment voucher, which you see right here at the bottom, the 720-V to submit the payment to the IRS. The link I've included in the slides today actually provide you the directions for completing your Form 720 as well through the IRS. So the one thing that, in addition to calculating the method, is you're going to need to keep the documentation. You need to be able to document what method that you use to determine the number of covered lives and to keep that enrollment data and all the calculations that you used. You need to keep these records for at least 4 years. Let's look now at our first attendance verification question. In order to give you CE for today's 1 hour webinar, we need you to answer the box, the answer to the question, name one method to count participants for the PCORI fee. So any of the methods I've talked about so far, if you will just use the Q&A box to answer that question so we know that you are still listening and participating in today's webinar, we can give you CE credit. If you're unable to find the question box in your dashboard for GoToMeetings, please go ahead and email me the answer. My email address is mbake@iiat.org. I see that some of you are absolutely typing in methods, and I appreciate that. I'm going to give you just another minute or two to make sure that we're getting everyone included on that. And remember, there are several different methods to calculate your PCORI fee. An interesting thing to do as a broker would be to go to PCORI.org and really find out what they're doing, what they're studying, how they're funded, and how that has really been brought upon by the Affordable Care Act. There's so many different aspects of ACA that most of us as brokers are familiar with. We're familiar with the pay or play provisions, the individual mandate responsibility. We know that there's guaranteed issue for everyone these days, but so many of the details really can just be found, whether digging through the Department of Labor, the IRS, PCORI. CMS also has lots of good bits of information for us as brokers. So looks like most people have chimed in with the methods to count participants on PCORI tax. There are several different ways, just to make sure that you guys remember what we could have used. Your answers could have included the actual count, snapshot count, snapshot factor method, and the form 5500. So if you use any of those answers, thank you for participating. And we will make sure to ask one more question, depending, just here in just a few minutes, just so we know that everyone's still paying attention. So let's look at the additional Medicare payroll tax. So this tax began in January of 2013, and it's a tax on high wage earners, which has a different definition depending on the individual's tax filing status. All employers, regardless of their size, are responsible for withholding this tax and submitting it to the government. The amount of the additional Medicare payroll tax is 0.9%, and it is withheld on all wages and income. Importantly, employers are not responsible for matching this tax. Only the employee pays this tax. This is really just an administrative process for many employers. It's a permanent tax as well, so this one won't go away or be phased out. Employers withhold and submit the tax to the government, and individuals actually reconcile that payment of this tax on their annual tax return. This chart shows the definition of high wage earners based on annual earnings and the filing status for each of the individuals. So filers who are married and file a joint tax return will pay this tax on earnings over $250,000, while if you're a single filer, only pay this tax on earnings over $200,000. Again, there is no responsibility on the employer's perspective to match this tax. So we see that all wages currently subject to the regular Medicare tax are now subject to new additional Medicare tax. That includes non-cash fringe benefits, tips, third-party sick pay, non-qualified deferred compensation. Employers should not try to determine the filing status of their employees. Rather, they should just uniformly withhold the additional Medicare tax of 0.9% beginning in the pay period in which the employee's wages exceed $200,000 in a calendar year. Employers should not withhold the additional Medicare tax to be collected on wages under $200,000, even if requested by that employee. Employees who are married and filing jointly may not ultimately be liable for this tax if their joint income is under $250,000. So those individuals may credit the additional tax withheld against their total tax liability when they file their Form 1040. Let's say, for example, Lily's annual wages are $225,000, so 0.9% is withheld on the last $25,000 of wages per year. Her spouse does not have income, and together they have no additional income. So this couple files jointly. This tax is only paid for married couples filing jointly if their earnings exceed $250,000, and that didn't happen in this example. So the couple can use the amount withheld by Lily's employer toward their total liability or get it back as a refund if no additional tax is owed. In contrast, so if you have an employee who is married and filing separately, they're liable for the new tax wages over $125,000, and they'll pay it on their 1040, their Form 1040. So another example, let's say Seth has $130,000 in annual earnings. Employers only withhold the additional 0.9% on wages over $200,000. So Seth didn't have the additional tax withheld, but he's married and he files his annual tax return separately from his spouse. So Seth will pay the additional 0.9% on $5,000 of his wages on his tax return. The existing Medicare tax, that 1.45% for employees and employers, is not affected or impacted in any way by this new tax. Let's talk about the reinsurance fee. It's another fee imposed on ACA. It is a 3-year fee. It started in 2014 due to sunset or in 2016, and this really was to help stabilize premiums in the individual marketplace because of the no guaranteed issue, no pre-existing condition limitation. The fee started at $63 per covered life in 2014, and it goes down each year. So in 2015, it was $44 per covered life, and this year it's $27 per covered life per year. Let me define a covered life for you. It's anyone who is covered by the plan, including dependents. This matches the PCORI fee in that definition. All size fully insured, self-insured, grandfathered, and non-grandfathered plans that offer major medical coverage must pay this fee. Major medical coverage is coverage that provides a minimum value of at least 60%. Small employer plans use an actuarial value, which is similar but not really exactly the same. All small employers are subject to an actuarial value, are not automatically considered major medical for this purpose. The fee is tax deductible as an ordinary and necessary business expense. But unlike the PCORI fee, this one can be paid with plan assets, which generally does include the employee and participant contributions via those payroll deductions. So we do see something a little bit differently from the PCORI fee when it comes to reinsurance. So it's generally easier to say what types of coverage are not subject to the fee than which are. So we have a list here: coverage, not meeting minimum value, plans that only consist of accepted benefits, HRAs integrated with self-insured or insured coverage. These are not required to pay the reinsurance fee. See health savings accounts, health flexible spending accounts or health FSAs. They are not required to pay the reinsurance fee. EAP, employee assistance programs, disease management programs or wellness programs that do not provide major medical coverage, stop loss or indemnity or reinsurance policies, plans are just prescription drug benefits, expat plans, Medicare primary plans, meaning that the group health plan is a secondary payer in that one. And then for 2015 and 2016 only, plans that are self-funded and self-administered. This means there cannot be a TPA in that process. The employer is adjudicating claims, helps with enrollment, so no TPA involvement under those particular plan designs. So another chart for you to calculate your taxes and fees, but this one really illustrates the timing to collect the data, to report the number of covered lives and make the payments. The data for this number of covered lives is only collected January through September of each calendar year. So the plan year start date or end date really is irrelevant when we look at reinsurance fees. The government annualizes the fee based on the number of covered lives in the first 9 months of the calendar year. So your plan must report the number of covered lives for the first 9 months of the calendar year by November 15th of each year. At that time, they just report the number of covered lives. They must also include scheduled payment of the reinsurance fees. So plans literally have to enter a date when the reinsurance fee will be deducted from a bank account. By the same date, the number of covered lives is due. Plans may pay in 2 installments. The bulk of the payment is due on January 15th of the year after the number of covered lives is reported, and the remaining, much smaller payment is due November 15th of the same year the January payment was made. Alternatively, the plans can pay the entire reinsurance fee by January 15th of the year after the number of covered lives was reported. I know this gets a little bit confusing, so an example is, let's say the number of covered lives in 2015 was reported by November 15th of 2015. If the plan paid the fee in installments, the bulk of the fee, $33 multiplied by each covered life, was due January 15th, 2016, and the remainder of the fee, $11, is multiplied by each covered life, and that's due November 15th of 2016. I don't know yet the amount of the installments for 2016, so we're still kind of looking at that older data for reinsurance fees. So just like the PCORI fee, when it comes to reinsurance, we have several different methods to calculate the contribution amount. The fully insured plans are really going to rely on their health insurance carriers to report the number of covered lives and pay the fee. The health insurance carrier has, probably raised the premiums in order to cover these particular fees. Also, like PCORI, the self-insured or self-funded plans have 4 methods to calculate the number of covered lives: the actual count, the snapshot count, snapshot factor count, and the Form 5500 count. And as I noted earlier, the data for the number of covered lives is only collected January through September of each calendar year, so the plan start date or end date really is irrelevant here. The government annualizes the fee based on the number of covered lives in the first 9 months of the calendar year. This is very different than the PCORI fee, when the number of covered lives was determined based on all 12 months of the plan year. So plans can use different methods to calculate reinsurance fee than they did to calculate the PCORI fee. And it's okay to use a different method each year. There's no need to use the same method as a prior year if that doesn't work out best for your plan. Your plan should calculate various methods to determine what's the best and hopefully least expensive for them as well. So you must report and pay the reinsurance fee using a free, secure government website. It's called pay.gov. As I already indicated, November 15th is the deadline each year to submit the number of covered lives and schedule the payment or payments. The payments are only allowed by using an automatic clearinghouse or ACH from a bank account. Employers or plans could not submit a check to the government for this reinsurance fee. Also, just one thing to remember is bank accounts often have a block on ACH transaction, or those automatic clearinghouse transactions, which could be called an ACH debit block, ACH positive pay, or ACH fraud prevention filter. Regardless of what they call it, the plan should contact their bank to unblock this. There are certain codes and values that you can use. It's reported up on the slide in order to get those fraud prevention filters removed. Also in 2014, the government required redundant documentation in the form of a CVS file. CSV file, but as of 2015, the CSV supporting documentations only needed, pardon me, if the submission is for 4 or more plans. In this particular reinsurance fee, the employer's plan sponsor should keep all the documentation relating to the reinsurance fee for at least 10 years. This includes what calculation method you used, where's the data that you used to collect the average number of covered lives, and certainly the confirmation page from pay.gov once that process is fully complete. So you need to make sure you keep those documents all for 10 years. Finally, we have another permanent tax in place. This is called the Health Insurance Carrier Tax. Although if you read the ACA in its entirety, they actually refer to this as a fee instead of tax. This particular fee began in 2014. It's only imposed on those fully insured medical, dental, and vision plans. Those self-insured plans and the related stop-loss coverage does not pay this tax. So for once, your self-funded clients get out of this particular fee or tax. Insurance carriers are responsible for paying the fee, but they absolutely pass along the cost to the consumers in the form of higher premiums, both to the employer and the employee. The Affordable Care Act mandates that a certain dollar amount be collected from each tax year. And this chart shows you the revenue collected by the government just for this one hit tax. In late 2015, though, Congress imposed a one-year moratorium on this tax for 2017. So the tax will not be collected for 2017. That means being paid in 2018. This should keep rates from skyrocketing in 2017. I know we're all hoping as we dive into this fourth quarter that we won't see these huge rate increases like so many of the news outlets are reporting. So carriers will divide the total amount to be collected based on each carrier's share of the prior year's net premiums written. So obviously if you're in a state with a pretty large carrier, has many market share points, they will end up paying more in their hit tax. Not of the net premiums are taxed though. So the first 25 million and 50% of the next 25 million are disregarded. If you're in the Medicare world, you know about the donut hole. Turns out there's a small donut hole in the hit tax or health insurance carrier tax as well. Net premiums also don't include commission, MLR rebates, and reinsurance cost. Many states have not seen MLR rebate checks being offered after the first year, so hopefully we will not see that this year either. Again, this chart really just illustrates the timing of the tax. Those taxes or fees must be collected by April 15th of each year. Carriers have to report their net premiums to the IRS for the prior year, and then the IRS is actually going to tell the carrier how much tax they owe by June 15th, then they'll be required to pay by September 30th. So the tax is not very appreciated or well liked in Congress. but like most parts of the Affordable Care Act, it's still here. There is a coalition called Stop the Hit, and they're working really hard to get this tax appealed. The coalition estimates that 1.7 million small businesses are impacted by this tax. And when you do the math, it really starts affecting 23 million employees. And since the tax is only imposed on fully insured plans, it adversely impacts small employer plans since those employers tend to have fully insured options. Legislation is pending in Congress. In the Senate, we have Senate sponsor Orrin Hatch of Utah has proposed 183 under the Jobs and Premium Protection Act. Also, we see in the House, we have House Resolution 928. It's bipartisan, and it really is looking to amend and repeal the provisions imposing those annual fees on health insurance providers. So there's also this is the last tax that we're going to talk about today. The last tax is the high plan value tax, and most of us call it the Cadillac tax. I'm sure the Cadillac company doesn't appreciate that, but we nonetheless still call it a Cadillac tax. This is a permanent tax. It was scheduled to begin in 2018, but Congress has deferred it to 2020. They made that change in late 2015. But it was to be an excise tax, and Congress made it deductible by employers also late in 2015. This is really, really good for great news for employers, especially those with employees subject to collective bargaining agreements. But the tax can impact all employers, small groups, large groups, fully insured, self-funded, partially self-funded groups too, grandfathered or non-grandfathered. It's a 40% tax on the value of the plan that exceeds $10,200 for self-only coverage and $27,500 for all others, an employee plus spouse or child or an entire family. So the estimated index thresholds for 2020 will be indexed at $10,800 and for families of $29,100. But please keep in mind that these are just estimates, and remember that we index up most of the ACA provisions, whether it's employer shared responsibility payments, whether it's affordability. We know that we're not saying 9.5% any longer. We're saying 9.66% as well. So that $10,800 is just an estimate only for 2020. We certainly hope that it will go up by then as well. So just a basic example. Let's say that ABC company, they have a value for employee only of $11,200 and $28,500 for their families, or anybody other than employee only coverage. The original thresholds have not been indexed, so the excess amount over that threshold is $1,000 per enrolled employee. 40% of $1,000 is $400. There are 50 enrolled employees, so 400 is multiplied by 50. So the Cadillac tax is $20,000 for this plan year. These thresholds will be indexed or adjusted based on the average age and gender of group if the average is higher than the national average. There's a cost of living adjustment. Some plans with high-risk occupation and retirees will have an adjusted threshold, and the threshold could be increased based on that health cost adjustments, which ties to the federal employee health benefit plan Blue Cross standard option. So more on the Cadillac tax. The IRS has not provided formal guidance, but generally speaking, when we talk about covering people, the Cadillac tax includes medical, dental, vision, health FSAs, including employee contributions. Remember, you can contribute up to $2,550 to a health FSA, employer HRA contributions, HSA contributions that are made pre-tax by both the employer and the employee, But note the annual contribution limits are fairly high, as well as Archer MSAs. Anybody remember selling MSAs in the business? You've been around a long time. By both the employer and the employee are included. So at this time, we think on-site medical clinics that provide more than de minimis care may also be included. It's still not known yet whether an EAP will be included in that or not. The applicable share of the excess benefit is also is the same ratio as the coverage provider's cost of coverage to the total cost of care. There are three different coverage providers. There's a carrier who is liable for the payment on fully insured plans. We have an employer who's liable for payment on HSA, MSA contributions, and then the person, and that really is that person who administers the benefits, is liable for the payment for any other coverage. This is typically going to be your TPAs. Your employers are required to calculate the tax and tell each coverage provider how much tax they have to pay. Remember a couple of slides ago, I used the ABC company had a $20,000 Cadillac Tax example. It's not necessarily ABC company that will write a check to the IRS. Let's say the plan is fully insured and the premiums account for 80% of the total cost of coverage. The employer allows employees to pre-tax their HSA contributions, which really accounts for the remaining 20% of the total cost of coverage. The fully insured carrier then will be responsible for paying 80% of the Cadillac tax, and the employer will be responsible for paying 20% of the Cadillac tax. Really, we look at a consequence of this tax so that employers might stop allowing employees to pre-tax their HSA contributions. Employers might drop health FSAs or stop contributing to HRAs altogether. It's probably going to be several years before we get a firm set of guidance from the IRS now that this tax has been delayed to 2020. So when you're going through fourth quarter renewals this year, it might not be something that you want to stress to your client right now. Certainly worth a mention. You know, the tax not liked well in Congress at all, but it's still, again, part of the Affordable Care Act. And there's a coalition called the Alliance to Fight the 40, and they're really trying to get this tax repealed. In 2014, there was a study done by Towers Watson. They estimated that about 82% of employers would be impacted by this tax in its first 5 years of existence. Remember, this is back when it was scheduled to start in 2018. There's legislation pending in Congress. The Senate has 2 bills pending, as does the House, and most of these bills have bipartisan support as well. And President Obama issued in his 2017 budget, in it he proposed changes to the Cadillac tax, really addressing the disproportionate effect on the sicker workers by requesting a study on the issue. The effect on employers and individual in higher cost geographic areas, when you start thinking about the Northeast and California, the thresholds could be greater than the amounts of that have already been put in place, or by the average cost of the marketplace gold plan in that state. And it really, the challenges of administrating and the application of the tax to FSAs, or your flexible spending account contributions, by proposing a standard FSA contribution that employers could apply across the workforce. Don't know whether Congress will accept these proposed changes, since they do anticipate costing the government about $1.2 billion over a 10-year period. You know, it's hard to make Congress move when there's a price tag attached. At this time, we have another attendance verification question in place. The question is, what year will the Cadillac tax kick in for employers? Just use the best year that we talked about today. Again, you can use the Q&A box. Most of you responded using that Q&A box at the bottom, or if you're having trouble finding the Q&A box in your dashboard, please email me that question. I'm sorry, that answer as well. So most of you are clicking in now to respond. The answer, if you are contemplating it, originally supposed to go into effect in 2018, but now the tax has been deferred until 2020. So even if you got the answer wrong but still clicked in, we're going to give you credit for being here today. So what do you take away from today? What action are you going to take knowing what taxes and fees are already being calculated in fees for your clients? So we all know that fourth quarter is dreaded by most health insurance agents. I would take the time to mention taxes and fees with my clients, both fully insured and self-funded. If you are selling self-funded, level-funded, or partially self-funded plans, you need to make sure to communicate that to your clients. They may need to know that they're going to budget for a lump sum payment. Some of your self-funded clients may choose to set aside money monthly for that. Others may just want to pay one time a year. Since we have had these taxes in place for several years at this point, what we really do see now is most of our clients are used to paying some of these fees separately. Some carriers are adding these taxes and fees as a different line item when we look at their premium billings every month. Others are not calculating it quite that successfully. So how are your clients going to calculate these fees? Which method will they use? Have they kept records since we started collecting these fees in 2013? It's really important to just do a small audit with some of your clients and say, let's look at your reinsurance fee. How did you calculate it? Show me the documentation that you used in calculating that fee. Also, if you're using a TPA, is the TPA going to calculate the fees for them? Is your TPA only using one method in order to determine those fees? Are they calculating all four methods and giving the employer group the opportunity to pick their own method? Of course, your employer groups are going to use the cheapest method possible. And remember that math is hard when it comes to the Affordable Care Act. You probably don't hear that phrase every day, but when you talk about taxes and fees, it's the one thing I like to remind agents is that it is difficult to calculate the fees. You have plenty of options. Sometimes more options equals fewer right answers. So that'll give you some two takeaway items for today. I want to thank you for your time today. If you have any Affordable Care Act or employee benefits questions and you're a member, please contact me. I'm your resource. I have all the ways to contact me, whether I'm in my office, my car, text messaging, email. I'm always available to you guys. You want to check the website, aat.org. We are going to have future webinars. We're going to do a webinar every month about the same time until December. We have CE classes scheduled for next year as well as seminars. We have a small agency conference and other conferences being held as well. So be sure to take advantage of all the programs we have offered today. If you didn't get a chance to answer the questions that I asked earlier in the dashboard, please go ahead and email those to me just so we can give you credit for today. Remember that it takes about 30 days to receive your certificate for attending this 1-hour CE. And again, this has been recorded. If you have any questions, you can go back and review the material we covered today. Thank you so much for your time. I hope you learned at least one new thing, and I will talk to you soon.